right, we'll go ahead and get started. Thanks for taking some time out of your busy day. I know there's a lot going on right now. So we're going to spend the next hour kind of just going through some call report impacts, and we'll talk a little bit of some accounting things, some day one entry information as well. For those of you that don't know me, I'm Aaron Kofir. I'm a partner here at the Bonadeo Group. And I'm joined today by Autumn Hayes, who's going to be taking us through a lot of the call report. I know Autumn spends a lot of time in the internal audit world here at the Bonadeo Group. So I'll turn it over to her momentarily with regards to taking us through the overall presentation. This presentation is a little bank heavy, if you will, but we do have some information, and we'll kind of talk a little bit to the credit union side as we move through here as well. The slides will be available as well as a replay of this call within probably by the end of next week, and that'll be included on the ampersand. You'll get an email that includes a link to these individual slides, as well as where you can find the recording of this presentation if you want to refer back to this in the future. So before I turn it over to Autumn, just our normal housekeeping slides. This is these are the views of ourselves and not necessarily those of the other partners or individuals at Bonadeo. And additionally, there is no tax advice being given on this call, as well as a lot of you know, I'm definitely not a tax person, but I will just put that out there as well. Okay, so with that, Autumn, I'm going to go ahead and turn it over to you, and let me know if you need me to move the slides or if I can be of assistance or anything else.
Yes, thank you, Aaron. As Aaron mentioned, I am on the internal audit side of the financial institutions team, and I'll just be going over a few of the schedules that have been impacted from CECL. So for financial institutions that have implemented the CECL methodology as of 1/1/2023, quarterly reporting will be starting for 3/31/2023. So I'll just go through the schedules here. So the first schedule is Schedule RC balance sheet. Some of the changes here applicable to the financial institution are on loans held for investment, debt securities, accrued interest receivable, other assets, and deferred tax assets. So on this schedule, specifically for item 2A for held to maturity securities, these are recorded at amortized cost and net of the ACL. So specifically, this line item should equal Schedule RCB securities item 8, column A, which is held to maturity amortized cost total, and that's less Schedule RIB Part 2, item 7, column B, which is the changes in the ACL for held to maturity debt securities due to any recoveries, charge-offs, write-downs, or provisions for credit losses. So essentially what that is saying is you're reporting the held to maturity debt security at amortized cost on Schedule RCB, item 8, column A, and reporting any changes in the ACL in Schedule RIB Part 2, item 7, column B. And the amortized costs minus the change in the ACL should equal line item 2A on Schedule RC balance sheet, which is the amortized cost net of the ACL. So that kind of takes care of the held to maturity debt securities on this schedule. Going down to available for sale debt securities for line item 2B, this is recorded at fair value net of the ACL. Which this should equal Schedule RCB, column D, item 8, which is the total for available for sale securities, which is the fair value column. So essentially what this is saying is you're reporting the available for sale security on Schedule RC balance sheet, item 2B, at fair value net of any ACL, required to bring the reported balance to fair value. And you're reporting the same security on Schedule RCB in column C for the amortized cost, which is not net of the ACL. With the ACL on the available for sale security is reported in Schedule RIB Part 2, Item 7, Column C, which is the changes in ACL for available for sale securities. So that kind of takes care of the held to maturity debt securities and available for sale securities on the schedule. I just wanted to jump to Schedule RCR real quick for these securities of where it's reported in Schedule RCR, which is in Part 2 of the risk-weighted assets for these securities. So for Schedule RCR Part 2, Column A, Item 2A for held to maturity securities, this is the total that is reported in Schedule RC balance sheet Item 2A, which is recorded at amortized cost net of the ACL. For Column B, Item 2A for the ACL on held to maturity securities, this is reported as a negative amount, with the amount reduced by any purchase credit deteriorated assets, which are acquired financial assets with determined credit weaknesses since inception. The number reported here are those allowances for credit losses eligible for inclusion in Tier 2 capital, but excludes allowances for credit losses on purchase credit deteriorated assets. Going down to line item 2B for available for sale securities. For column A, line item 2B, this is the total as reported in Schedule RC item 2B for available for sale securities. For column B, line item 2B for available for sale securities, this is assuming that a financial institution opts out of the election in Schedule RCR Part 1, Item 3A for accumulated other comprehensive income. So here you're reporting the unrealized gain or loss as determined by the variance between Schedule RCB, column C, the amortized cost, and column D, the fair value. There's no ACL on available for sale securities adjusted out of this column B on Schedule RCR. So that kind of takes care of Schedule RCR for these two securities, held to maturity securities and available for sale securities. Going back to Schedule RC balance sheet, just touching base on some of these next line items. For line item 2C, these are equity securities with readily determinable fair values not held for trading. These are recorded at fair value and are not subject to CECL. So they're outside the scope of CECL. Going down to line item 4 for loans. So for line item 4A and 4B for loans held for sale and loans held for investment, this must equal Schedule RCC Part 1, Item 12, which is total loans and leases. Going down to line item 4C, this is just reporting the ACL on loans for held for investments only. Allowances established for other financial assets are not included in this line. For line item 4D, loans held for investment, this is so that line item 4D, this one is loans held for investment net of the ACL. So essentially it's line item 4B net of line item 4C. And then lastly, for line item number 11 for accrued interest receivable and other assets, you would be reporting the amount of the accrued interest receivable net of any ACL to include any purchase credit deteriorated assets for the allowance for credit loss. And this line item number 11 must equal Schedule RCF other assets item number 7. So that kind of takes care of Schedule RC. I know I kind of might have talked a little fast on that, but if there's any questions that come up, feel free to ask any questions.
So Autumn, just to take it back to like some of what we're kind of used to, and maybe this is more of a gap question. In the financial statements, we're going to see these individual captions, right? Like held to maturity net of ACL now kind of thing, right? I mean, that's kind of something new. And that's going to be not only for held to maturities, but also for available for sale. So it's going to, those amounts, I'm assuming, are going to kind of tie back to this Schedule RC on the balance sheet. So it is going to be, to a certain extent, crosswalking from your financial statements if you do interim financial statements or even your trial balance to a certain extent. I know we'll get into later on in the presentation where you should be capturing these individual allowances specific to the type of asset that has an allowance recorded against it or liability if it's unfunded, to ensure that you can appropriately crosswalk to your individual call report per se. Is that
Right, yes.
okay? Perfect. And I just muted you, Autumn. Sorry. So okay, so I think that helps, just at least for me to understand it a little bit in the sense of ensuring that there's going to be some sort of crosswalk, because I think it's important to note that when as the regulators start to come in and look at these call reports and that sort of thing, it's probably going to be a little bit of a learning process between what we've done in the past and kind of getting them comfortable with our call report to a certain extent too. So I think it's important to make sure that we've got everything documented on our side of the house, so that when the regulators do come in, that we can just present it to them and say, here's where these informations are coming from and that sort of thing. So just wanted to just add that in there. Hopefully I didn't say anything wrong. You can tell me if I did.
Thank you. So going down to Schedule RI income statement, here you're kind of just reporting all credit loss provisions. So for specifically line item number 4, the provision for loan and lease losses line, in this line, you're reporting the credit loss provisions on all financial assets and off balance sheet credit exposures that fall within the scope of the standard. So this line has a whole bunch of, so it includes a whole bunch of different line items from a different schedule in here. So specifically for Schedule RIB, Part 2, which is the changes in ACL, item number 5, columns A through C. This includes the provision for credit losses on loans held for investment, held to maturity debt securities, and available for sale debt securities. And then you're adding in Schedule RIB Part 2 memo item number 5, which is the related ACL on other assets, or provision for credit losses on other financial assets measured at amortized cost. And then adding in Schedule RIB Part 2 memo item number 7, the provisions for off-balance sheet credit exposure credit losses. So all those added together should equal Schedule RI item number 4. So there has been a recommendation that has gone out for creating new GL accounts for these different provisions. So I'm sure there has been provisions already for like the provision for loan and lease losses, but there has been a recommendation to create new GL accounts for provision for held to maturity securities, provisions for available for sale securities, provisions for other assets, and provisions for off-balance sheet credit exposures, just to make sure that you're capturing all of them and making sure they're separated out, because on Schedule RIB, it is separated out on that schedule. So just making sure that they fall in the correct category in that schedule, which is the changes in the ACL. So that kind of takes care of Schedule RI income statement. Those were kind of the only changes on that schedule for ACL or CECL. Did you have anything else to add, Aaron, for that schedule?
No, I think that's good. I think, again, it just reiterates that the separate accounts is definitely important from a tracking perspective as well.
Thank you.
I can flip the slide, right? Good to go?
For going back to the other slide, Schedule RIB, sorry.
Nope, no problem.
So for Schedule RIB, which is the charge-offs and recoveries on loans and leases and changes in the ACL, I kind of mentioned a little bit of what has changed in the schedule, but just kind of doing a deeper dive in the schedule real quick. So for this schedule, for Part 1, you're reporting charge-offs and recoveries in this part. So for items 1 through 8, you're reporting all charge-offs and recoveries for the loan classifications that are noted in Schedule RCC, which is the loans and lease financing receivable schedule. So it is broken out by those categories also. Going down to part 2 of this schedule, this schedule is pretty much like a recap of the year-to-date activity in the ACL account. So kind of like a roll forward of the financial institution's ACL for loans held for investment, held to maturity debt securities, available for sale debt securities, and those kind of categories. So for this part 2 in Schedule RIB, for columns B and column C, which is column B is held to maturity debt securities and column C is available for sale debt securities. Line item number 1 is the starting balance for line item number 1 will be 0 for year of CECL adoption, because that hasn't been there in the past. So it's starting at 0 for held to maturity debt securities and available for sale debt securities. Also in part 2 of this schedule, line item number 5 for provision for credit losses, as mentioned earlier, for this schedule, line item number 5, columns A through C, the provision for credit losses on loans held for investment, held to maturity debt securities, and available for sale debt securities, plus get this same schedule, part 2, memo item number 5, the related ACL and other assets, plus the same schedule, part 2, memo item number 7, provision for off-balance sheet credit exposure, credit losses, which all these added together must equal schedule RI income statement line item number 4.
And other assets in this situation would be like accrued interest receivable, correct? That would be covered in this individual schedule. That's where you would, if you did have a reserve on that, that's where you would put that, correct?
I believe so.
Right? Yeah. Okay. All right. That's good.
So then for the same schedule, part 2, item number 6, these are any adjustments that would be reported here that cannot be properly reported in the above line items. So in this line item, you would report any adjustment made to the ACL that did not originate through an accrual of a provision through the income statement or a charge off or a recovery. This adjustment would also need to be described in Schedule RIE explanations. Also within this part, line item number 6, adjustments for the adoption of CECL, like the day 1 adoption entry. If there was one, the financial institution must report the ACL transitional amount in this line. So if the day 1 entry required additional amounts to be recorded to the ACL, it is reported as a positive figure. If the day 1 entry required less amounts to be recorded to the ACL, if it was initially determined that the financial institution was over reserved, then it would be reported as a negative figure. And it would be the amounts for loans held for investment, held to maturity debt securities, and available for sale debt securities. Going down to part 2, item number 7, column A, this line item must equal Schedule RC item 4, which is the ACL for loans held for investment. For column B, for the same line item number 7, this is the amount needed to equal Schedule RC item 2A, held to maturity debt securities, and Schedule RCB, column A, item 8, for held to maturity securities at amortized cost. And then the last one here for column C in the same line item number 7, this is the amount needed for Schedule RCB, column D, item 8, which is available for sale securities at fair value, and Schedule RC item 2B, which is available for sale securities at fair value. So that kind of takes care of Schedule RIB, which is the charge-offs and recoveries and changes in the ACL. So I think you can move to the next slide, Aaron. Thank you. So moving on to Schedule RIC, which is the disaggregated data on the allowance. This pertains to financial institutions with greater than 1 billion in assets. So this would only pertain to them.
I think it's important to point out here, and I know we have a bullet on it here, and maybe you're going to touch on it momentarily, but from an unallocated perspective, there is no requirement to have an unallocated under CECL. So if you're one of the banks that has over $1 billion in assets and you're sitting here and you're like, shoot, I don't have any unallocated amount, that's okay. You don't need it under this new model.
Right, yep, that is correct. So if you do have to do this schedule, you would report by loan segment the amount of the amortized cost of loans by loan segment that is reflected of management's risk characteristics allocation in column A. For the segments in lines 1 through 4, which is real estate loans, commercial loans, credit cards, and other consumer loans. It's not required to match Schedule RCC loan coding. So it's those lines 1 through 4 are not required to match RCC loan coding. The total in line item number 6 that must equal Schedule RC item 4C, which is the allowance on the balance sheet schedule. This will also not include any ACL on held to maturity, available for sale, or other assets. For line item number 5 for unallocated, as Aaron mentioned, it is not a requirement to have an unallocated amount. But if there was any, then it would be reported in this line. For line item number 11, which is the total, it has to equal Schedule RIB Part 2, column B, item number 7 for held to maturity securities. So that kind of takes care of Schedule RIC. Going down to Schedule RIE explanations. This kind of talks about the day one adoption entry, if there was one. So for line item 4A for this schedule, which is the effect of adoption of the CECL methodology, this would be the CECL transitional amount from the day one entry. So it would be the amount that was recorded to retained earnings in the day one entry. And this amount should also be included in Schedule RIA item 2, which is the cumulative effect of changes in accounting principles. Going down to item 6A, sorry.
Yeah, no, and I think it's important to note that this is a schedule that it's going to be a 1-year thing, right? That has to start right now with this call report cycle, the 331 call report cycle. With this report, this schedule, right, will need to be filed here going forward. But after this first year of implementation, it falls off because we've implemented it, and you'll have technically thinking comparable data, which is the thought process behind why you don't need it next year. Unless you obviously, if you have a material accounting error, then you may have to revisit it. But from a CECL perspective, once we're through this initial year of adoption, you won't probably, let's hope you don't have any material accounting errors. You won't have to do it going forward.
Right. So yeah, specific to the schedule, it would be for a year of adoption only, for the day one adoption in this schedule. And then also for line item 6A, this would be the adjustments to ACL for initial allowances for credit losses recognized upon acquisition of purchase credit deteriorated assets on or after the effective date of the standard. And line item 6B is adjustments to the ACL for effects of adoption of the CECL methodology on ACL. So essentially, line item 6A and 6B would actually come from Schedule RIB Part 2, item 6 for the adjustments made. Moving down to Schedule RCF for other assets. So this includes accrued interest receivable and deferred tax assets. So for line item number 1 for accrued interest receivable, you would report the accrued interest receivable amount net of any applicable allowance for credit loss to also include any purchase credit deteriorated allowance for credit loss. This also pertains to all other assets reportable in this schedule. For line item number 2 for deferred tax assets, no adjustments will be made here related to the election that was made for the transition provision in Schedule RCR. So therefore, if the deferred taxes net is a debit, you would report in Schedule RCF other assets line item number 2. If deferred taxes net is a credit, you would report in Schedule RCG other liabilities, which is line item number 2. Also within Schedule RCF, other assets for line item number 7, the sum of items 1 through 6 must equal Schedule RC line item number 11, other assets, which I believe was mentioned earlier also. And I think you can go to the next slide, Aaron.
Okay. I got excited last time, so I'm very gun shy now as to flipping around.
Going to Schedule RCG for other liabilities, this kind of talks about the off-balance sheet credit exposures in the schedule. So for line item number 3, it's the allowance for credit loss on off-balance sheet credit exposures. So here you would report the amount of any allowance for credit loss on unfunded commitments, but you would exclude allowances established for off-balance sheet credit exposures that are unconditionally cancelable, as these are outside the scope of CECL.
So let's talk about that real quick, just from an unconditionally
Sure.
canceled. I'm sure everybody understands what that means, but it's like if you can basically not extend credit for with or without cause or anything like that, then ultimately they're outside of CECL. So you just have to make sure that when you're looking at the going through this calculation of part of your adoption, that you're making sure that these items do have that they're not unconditionally cancelable unfunded commitments, because if they are unconditionally cancelable unfunded commitments, then they're outside the scope of CECL. A lot of words in there to make sure to make it clear. So
yes, thank you. So that kind of takes care of Schedule RCG for other liabilities. Going down to Schedule RCK, quarterly averages. So it's the averages that should be calculated based on the amortized cost, and then ACL, which is deducted from the average assets. So the quarterly averages for all debt securities, for both held to maturity debt securities and available for sale debt securities, should be reported at amortized cost. And this is not net of any ACL once CECL is adopted. And loans should not be reduced by any ACL, and total ACL on loans should be deducted from average assets. So that kind of takes care of that schedule. I'm going down to Schedule RCR, regulatory capital. This is probably one of the most important schedules for the adoption of the standard, because it takes care of the retained earnings part, and the day one adoption entry, and the CBLR framework impact. So for Schedule RCR, regulatory capital, for Part 1, Item 2 for retained earnings, the amount reported here is the amount in Schedule RC Item 26A, which is the retained earnings, which would include the applicable CECL transitional amount if a 3-year transition provision is made. So for Item 2A, for the day one entry that was made for the adoption of CECL, and it required additional amounts to increase the allowance, financial institutions have the option to elect either no transition provision, which you would enter 0 for line item 2A, or a 3-year transition provision, which you would enter 1. And this would help for the negative impact to CECL. So you could enter 0 for no transition provision if you feel that the bank has excess capital, and that there would be not a negative impact to capital, and it wouldn't hurt capital ratios, as you believe that the financial institution is relatively healthy. So there would be no adjustments made to retained earnings on this schedule. But if you select that option to do a no transition provision, you cannot then opt into the 3-year transition provision in subsequent quarters. So if you actually do want to do the no transition provision, you would select it in this quarter, but you cannot then opt in for the 3-year transition provision in later quarters. Or you could enter one for the 3-year transition provision, and you would phase in the negative impact over a 3-year period. The election must be made in this first quarter, because as mentioned, you can't select 0 and then go to the 3-year transition provision in subsequent quarters. So in the first year, retained earnings would be increased by 75% of the CECL transitional amount from the day 1 entry. For year 2, retained earnings would be increased by 50%. And for year 3, retained earnings would be increased by 25%. I don't know, Aaron, if you wanted to mention something on the 5-year transition provision that's no longer available.
Yeah, but I asked you one question. Like, is this something that, and maybe this might be a question for everybody on the call. If you type 0 now, is that going to lock? And so like when you come to do your second quarter call report, it's going to default to that? Or is that something that's going to have to be put into the system each time? So you're going to have to look back to determine, well, you probably will remember, but does anybody know if that's something that's system generated, or is it has to be input every time? And maybe Autumn, you know the answer to that.
Personally, I don't know if that would be like something in the software, if it would be locked for that. If they did select 0 and going forward, it would be locked for that. But
okay, so I guess just cautionary that once you make that election, that you make sure that it's going to have to be consistently applied, as Autumn said. Now the option 2, the number 2, if you put number 2 in there, that's not available to you, but that was a 5-year transition for larger, super big, like the monsters, the big banks, the Chases, the Wells Fargos of the world, and they had a 5-year transition period in, because they were required to adopt in Q1 of 2020. So don't think that's why it's not available to anybody at this stage, is because it's phased out.
So there's some common questions here that have been received. So is a 3-year transition provision period for call reporting purposes only? Yes, so it's only for call reporting purposes. Does the reserve for unfunded commitments need to be fully reserved on day 1 as well? This is also yes, they need to be fully reserved on day 1. Does the day 1 adjustment for both loans and unfunded commitments go through retained earnings? This is also yes. They need to go through, it must go through retained earnings. And the last question here, I'm still confused about how to treat accrued interest receivable. What should we be doing? This is a policy election, so it's a policy election.
So just a couple comments on this from a GAAP financial statement perspective. The 3-year, unfortunately, you can't bleed in your CECL adjustment over 3 years or 3 quarters. If it's whatever that impact is on day 1 that you record, that you have to hit retained earnings, either up or down of retained earnings, that has to be recorded. You can't, the 3-year transition period is only for call reports. It is not a GAAP financial statement item. Also, with regards to the adjustment for the day 1 adjustment going through retained earnings, again, it doesn't matter if it might be different amounts. You might have one amount for loans and a different amount for unfunded commitments. Ultimately, whatever that impact is from a retained earnings perspective, when you're looking at it, that's the number that would get recorded. And then, as Autumn mentioned, this is a policy election for accrued interest receivable. And so ultimately, that's going to go into your financial statements as well, as to how you're accounting for that. And also, that will be part of your new disclosure requirements that will be forthcoming as well. So just a couple things on that. So anything else to add, Autumn, on that?
I think we're good there on that. I know that was probably a lot of information on the schedules. But if there's any questions, feel free to ask. I know the roundtable is also being recorded too, so hopefully it can be played back and to go through the schedules.
Perfect. Excellent, thank you. And I'm sure if anybody does have any questions, do feel free to go ahead and put them in the chat. We'll definitely try and address any questions that we do have. If we don't know the answer, we'll definitely follow up with you, even as potentially as part of that overall communication that does go out. So one thing that does get often overlooked with regards to some of these entries is there is a tax impact component with regards to these entries. So one of the things we wanted to kind of highlight here today is, what does that tax entry look like? And so I think if you look at some of the disclosures that are out there, they will be showing the adoption will include what the gross amount is, as well as what the amount is that is reduced from a net tax basis. And I kind of created this little simple example here to kind of show that the overall increase in the allowance as a result of adopting CECL was $5 million gross. So you would have a increase on the allowance for the credit loss of $5 million. And this is a day one entry. This is not we're 2 months into it and what do I do? This is a day one impact only. And I've got my normal statutory tax rate, which will generally differ by institution. And obviously credit unions don't have any sort of income tax impact for the most part, generally. So 21%, you know that you have a $5 million hit to retained earnings, because again, it's not a P&L item on day one because you're adopting. And then you would take 21% of that amount to record your deferred tax asset. And so ultimately the entry is here. So that's kind of how the tax entry is done. And I'll just leave it at that because it is tax. If you want me to get geeky in tax and cite you the tax code, I'm more than happy to do that, but I'll admit that's boring even for me. So I'll spare you the pain of listening to me rattle that off. A couple other day one matters. In this instance, right, we had to increase the allowance, right? So the question is, well, what if I'm going the other way and I have to reverse the allowance? Well, ultimately, it's going to basically be the same type of scenario and the same type of entry. It's just going to be flipped. So you would be debiting the allowance for, let's say, the 5 million in this instance. Let's say the facts are the same, but we were, instead of being under reserved, we were over reserved. You debit the allowance for $5 million. You would actually be crediting your deferred tax asset for the 1,050,000, and then crediting retained earnings for the 3.950 as well. So you still would have to record it, even if it is a negative. You're still recording that number net of taxes. Now, let's talk a little practicality here with regards to the journal entries. I think we're all amongst friends, and we would all assume that we on day one did not roll into the office after the new year, sit down at our computers and put this information into the individual trial balances that we did. If you did, that's great, but I'm going to assume a lot of us did not. So that being said, when you do record that entry, regardless if you record it as part of your quarter end close and reflect it as a 1/1 entry, or you booked it in the middle of February, whatever the case may be, you still have to hit, and you still need to know what your opening day one entry was, because there is an impact on the overall retained earnings number. So you can't fast forward to 3/31 and say, okay, what is my CECL reserve? And then just book the expense and the allowance. That's not appropriate. You need to have that opening P&L or opening retained earnings, impact recorded. You cannot bleed it in. You cannot leak it in. It's got to be a separate. My day one impact for CECL was X. And that's important because of obviously call reporting. It's also important from a GAAP perspective. Disclosures will be driven by that, et cetera, et cetera, et cetera. So that's just something to keep in mind. Again, I know we talked about making sure that there's separate trial balance accounts for these reserves, since there's a mapping that will probably occur to a certain extent between your financial statements and your call report. And then lastly, the last thing we want to touch upon is, don't forget about the off-balance sheet and unfunded commitments. I think we want to just remind you that these now do need some sort of allowance against them as a result of CECL. So just a couple things to remind, just a couple reminders on that. And I know we talked about the unconditionally cancelable unfunded commitments. That's definitely a mouthful for me, so I won't go through that again. And then the amounts that are recorded are going to be in the non-interest expense and the other liabilities accounts for those any provisions or reserves that we record against those off-balance sheet unfunded commitments. So I think that takes us to the end of our overall presentation. So we're more than happy to see if anybody has any comments or questions, and we can open up the floor for dialogue or anything like that, and kind of take it from there. Okay. Well, I guess if you do have questions subsequent to this call, again, definitely feel free to reach out, and we'll definitely take those questions back, circulate them, and respond back accordingly. Again, probably within a week, this recording will be up so that you can hear, you can go back and revisit the individual content that was discussed. But with that, I think I'm going to go ahead and close it down unless you have any final remarks, Autumn, and wish everybody a great rest of your day.
Yeah, thank you, Aaron. I think you covered it all. So thank you. And thank you everyone for attending this roundtable session number 3.